Good afternoon. This morning the inflation number everyone was terrified of came in cool. Prices are rising slower than anyone expected. On paper, that's the green light the market waited a month for, and yet the day's biggest story isn't the inflation report at all. It's that IBM, a 114-year-old blue chip, just fell about 25% in a single day, its worst day since 1987. Not because of inflation, because of artificial intelligence. And that tells you what's really driving this market. It isn't the Federal Reserve, it's a vortex. Let's get into it. Here's the board. Stocks fell hard on Monday. The S&P closed down about 0.8%, near 7,515, and the Nasdaq dropped over 1.5%, dragged down by a rout in chip stocks. The Dow held up a little better, but was weighed by that IBM collapse. Now the crosscurrents. Inflation cooled sharply this morning, headline down to about 3.5%. But the 10-year Treasury yield is still around 4.5%, and Brent crude is near $85, up more than 10% on the week on a new blockade in the Strait of Hormuz. Gold is near 4,050, capped by those high real yields. Bitcoin is soft, near 62,600, and the market is dangerously narrow. The biggest 7 companies are about a third of the whole index. Good inflation news. Into a top-heavy market that just cracked. Now the signature segment, consensus versus the read. First, everyone woke up today and read the cool inflation print as the all-clear. Prices are cooling, the Federal Reserve can finally cut, risk on, but look at what the tape actually did. Chips sold off, a blue chip lost a quarter of its value, and the selling started before the inflation number even landed. The market isn't trading the Federal Reserve right now. It's trading one enormous force that is sucking capital out of everything else. The inflation report is a sideshow, high conviction. Second read, and this is today's deep dive. Everyone is treating the IBM crash as a company-specific stumble. Its own chief executive got on the call and said, quote, "We faltered. Case closed, bad management." But read what he actually said next. The big deals didn't close because customers diverted their budgets to artificial intelligence servers and memory. That is not an IBM problem. That is the tell. The artificial intelligence build-out is now so large, about $725 billion this year, that the money has to come from somewhere, and it's coming out of everyone else's budget. IBM is the first big, visible casualty of the crowding out. It will not be the last. High conviction. Third read. Michael Burry, the investor from The Big Short, just stacked bets against the whole chip complex, Nvidia, Micron, the semiconductor index, and said the end is nigh. The crowd is dismissing him as the boy who cried bubble. And to be fair, his 30% crash call is his opinion, not a fact, and he has been early before. But the mechanism he's pointing at is real. When one trade gets this crowded and this large, the reprice doesn't start at the top. It starts at the edges, in the leveraged, commodity middle. Monday's rout in memory and second-tier chip names is exactly that. Early is not the same as wrong, medium conviction. Here's the tell, the single most revealing data point of the day. Put 2 numbers next to each other. On one side, the 4 biggest spenders will pour about $725 billion into artificial intelligence infrastructure this year, growing far faster than their own revenue. On the other side, IBM, a blue chip that has paid a dividend for a century, just fell 25% in a day because its customers spent their money on that build-out instead. That is the whole story in one frame. The vortex is so powerful it's not just lifting the winners, it's actively draining the losers. And the crowd is staring at an inflation report while a $100 billion reallocation rips through the tape underneath them. When a trade gets big enough to cannibalize the rest of the market, the question stops being, is the demand real? It becomes, who's next? Follow the money. The macro regime just got more complicated, not less. Yes, June inflation cooled, headline down to about 3.5%, quarter 2.6, both below forecast and the biggest monthly drop in years. But here's the catch. That cooling was mostly energy prices falling. And this week, a fresh blockade of the Strait of Hormuz, about a fifth of the world's seaborne oil, sent Brent crude up more than 10%. The very thing that made inflation look tame is now reversing. So the Federal Reserve is stuck. It is very likely on hold at the end of July, roughly a 70% chance of no cut, because it can't ease into an oil shock. The dollar is firm, the long bond won't rally. Good inflation news, with an oil-shaped asterisk. Gold and crypto round out the picture. Gold sits near 4,050, pinned by high real yields. An asset that pays nothing struggles when safe bonds pay 4.5%, even as the oil scare adds a bid underneath. Bitcoin is soft, near 62,600, and the exchange-traded funds bled about $425 million on Monday alone. And the symbol of the moment, Michael Saylor, whose entire brand was never sell your Bitcoin, just sold. His company's strategy offloaded about $216 million of Bitcoin, its largest sale ever, to pay dividends, with its treasury deeply underwater. On positioning, our market and social sentiment monitoring shows conviction draining out of the crowded trades and into cash. When the loudest holder sells, pay attention. Sectors in play. Legacy technology is the marquee casualty. IBM's crash is the crowding out made visible, and the read is to watch for the next enterprise incumbent to say the same thing, that its customers spent the budget on artificial intelligence instead. Semiconductors and memory are the second front, where Michael Burry's short and Monday's rout, Nvidia down 3.5%, Micron down over 4%, look like a periphery reprice rather than a demand collapse. Because the big platform owners held, and the banks are the quiet winner. JPMorgan crushed it, earning $6.14 a share against $5.85 expected on $58 billion in revenue as all five giants report into the same session. A higher for longer Federal Reserve is a tailwind to their lending margins, the exact opposite of how the rate cut crowd is positioned. On the radar, tomorrow a SML reports, the company that makes the machines that make the most advanced chips, the cleanest read on whether artificial intelligence demand is still accelerating, plus producer prices. Thursday brings TSMC, the definitive tell on chip demand, and Netflix after the close. Around July 18th, the deadline for the new stablecoin rules, a crypto law that is quietly a giant new buyer of government debt. Then the Federal Reserve decision on July 29th, where oil is the swing variable, and in early August, the deadline on the broader crypto market structure bill. A week that will tell us if the Vortex is still accelerating. For the scorecard, 3 new calls on the record. 1. IBM's crash is crowding out, not a one-off. Within 2 quarters, at least one more enterprise technology incumbent guides down and explicitly blames budget diversion to artificial intelligence. 2. The cool inflation print does not buy a July rate cut. The Federal Reserve holds on July 29th because the oil shock rearms the inflation tail. 3. Burry is early, not wrong on direction. Over the next quarter, the second-tier chip names, memory and equipment underperform the big platform owners as the reprice hits the middle first. And one honest note from last week, we called Brent unlikely to sustainably hold above $80. It's near 85 today on the blockade, so that call is under pressure, and we are watching whether the strait actually closes. We date them, and we grade them, including the ones going against us. So here's the question worth sitting with. The whole market spent a month terrified of today's inflation print, and it came in fine. But the number that actually moved the tape wasn't inflation. It was a 25% crash in a blue chip whose customers spent their money on somebody else's artificial intelligence build-out. That's the Vortex. It's strong enough now to make the winners soar and the bystanders bleed on the same afternoon. Records get made when a rising tide lifts everything. This isn't that. This is one trade draining the pool, so don't watch the inflation report. Watch who gets pulled under next. Today's deep dive on the IBM story is linked right below. This is Earl, one contrarian read a day. Subscribe.